Just like a nation requires a budget due to its limited resources, so does an individual in order to attain a good financial standing. Hi everyone, my name is Harsh Srivastav. I am an ex-investment banker, a business owner, and a part-time content creator. On this channel, I talk about real estate, stock market, insurance, investing, cryptocurrencies, and much more. In today's video, we will be talking about how you can manage your hard-earned money by using the method of budgeting. So let's get started with the video. For a better understanding, I have decided the process of budgeting into 5 simple steps. Let's start with the first one. The first step is to calculate the sum of all your disposable cash inflows. The disposable cash inflows can be anything ranging from your in-hand salary to your pension, to your interest income from savings accounts or even fixed deposits, to equity gains from equity investments, or any side hustle that you're doing but it makes you some money. So once you have calculated the sum of all your disposable cash inflows, we move on to the second step, which is to calculate all kinds of cash outflows and leakages. Now I say the point leakages because there are certain expenses which you do not plan for. For example, suddenly your car battery dies and you are stuck in the middle of the road. You are bound to call a battery shop and get a battery for your car. That expense is something that we do not plan for. However, there are certain cash outflows which we plan for and we know that they incur in a repeated fashion every month, such as your home expenses, the grocery or the dine out expenses. You might also go to your office through a vehicle, or if not, use a public transport. So the cost of transportation also comes in. Like you are watching a video right now, you might also be using paid content services such as Netflix or Amazon Prime Video. In that case, that also qualifies to be part of your monthly expenses. And lastly, not something that I'm proud of, but there are people who incur heavy expenses through their credit cards and even incur EMIs for the same. So credit card bills or paying off EMIs also qualifies to be part of your cash outflows. Our third step comes in here where we optimize the cash inflows and outflows in order to create a budget surplus. If you fall into situation 1, your cash inflows are less than your cash outflows. In that case, you are in a budget deficit. My dear, you need to work really hard to increase your income or reduce your expenses, because only then you will be able to work on your budget surplus and maximize it. However, if your cash inflows are greater than your cash outflows, good news, you are in a budget surplus. Well, all you need to do is put your money to the right place and keep on maximizing the budget surplus. A budget surplus, which is equivalent to 15 to 20% of your disposable income, is a really good benchmark to reach. So now comes the fourth step of budgeting, where we take care of emergency fund, insurance, and debt obligations. What is an emergency fund? An emergency fund is an amount of money that you set aside in a liquid fund or a savings account in order to meet your unexpected expenses. They can be your sudden medical expenditures, they can be your car repairs or even household repairs, and so on. This emergency fund needs to be equivalent to at least 6 months of your cash outflows. The next thing you need to do is take a term life insurance. However, whenever you go out to insurance companies to take a life insurance, they might end up selling you endowment policies wherein you have to pay a huge sum of money and you will be getting some amount of money in the future years. Please do not fall into such insurance traps. You should aim to take term life insurances wherein the premium is paid and you do not get any kind of returns in the future. The premium gets exhausted at the end of the year. Also, we do not know what might happen in the future, so having a health insurance is your primary duty. Lastly, you might have debt obligations such as a car loan, a house loan, or an education loan. So you need to identify which are the high interest loans and start paying off them first. So most probably your education loan is going to have the highest interest rate. So aim to finish that off first. After that, you might try to end your car loan. And lastly, you can try to pay off your house loan. So once you have taken care of the emergency fund, the insurance and the debt obligations, now comes the fun part. Let's go to the fifth step of budgeting, which is directing your budget surplus to income generating assets. As I talked in the last video, there are various income generating assets where you can put your money to work. Some of my favorite ones are real estate. You can put your money into real estate investment trusts, or if you can afford, you can buy a commercial property. Also, you might have a good know-how of finance, so you can go ahead and invest your money in the stock market or buy equity mutual funds. Even the government wants you to save. So there are schemes such as the National Pension System, or you can put your money in the Employee Pension Scheme. If you're not a very aggressive investor, you can put your money in debt funds or gold ETFs. Lastly, you can invest in index funds. Index funds carry low expense ratio and they are ideal for moderate investors. Thank you so much for watching. Hit that subscribe button, click on the bell icon and stay tuned for my next video.